Hey, welcome back. It's been a while since I looked into gold miners and many of them are advancing in an interesting direction while the price of gold remains very high. I try to look into large, medium and smaller companies that I think represent their size pretty well to get an idea about the broader industry. We can see the all-in sustaining cost for gold keep going up, which offers kind of a limit to how much it can fall. Because if it falls to 1600 now, you lose like a quarter of the production. Fall to 1400 and you lose like half of it. Since they become unprofitable, we would see mines begin to close, cost reductions and so on. At the current price, around 97% of the production is basically profitable, so everyone makes money. Gold at 1.2, 1.3 thousand we saw even in 2018-19 is possible but not sustainable for long. Look at the cost back then being even below 1000, so it's up like 50% today. Something interesting about gold and why I say it's currently in a pretty unique spot that we don't see with other commodities is how the companies reacted to the boom. You'll see in the video that all of them ramped up the CAPEX, but for a majority of them it wasn't to develop a new mine. This was either for improving the lifetime of a current mine, doing some big maintenance or improvement, or in some cases developing the copper production. That's at best I'd say maintaining the overall production capacity, meaning the supply. If you look at lithium, copper, iron or whatever commodity you want, the companies invested massively in growing the production capacity. Lithium companies, for example, had plans to double, triple, maybe even quadruple the production by 2030. Sure, that's an extreme example, but any net increase has an effect on the supply and ultimately the price of the commodity. With gold, it's almost as if these companies do it on purpose, especially since this is a very merger and acquisition heavy industry. Instead of opening a new mine, which they do but not that often, these companies have always, especially in the past half a decade, preferred buying another company. I guess it makes sense to overpay a bit but you get the production today, not in a decade, but that's a net zero for the global supply. Not only that, but mines eventually run out and the bigger miners prefer replacing the decayed production with metals like copper, which is a great commodity but again doesn't add anything to the supply of gold. Then, if we have a recession, certain events or even rate cuts that would boost the demand for gold, we've seen what happens to the price. Getting to 3000 per ounce, a number that you would have been made fun of if you even mentioned a decade ago, is easier than ever. And I also want to mention again that gold is among the only commodities on the planet that doesn't depend on China. The demand for gold comes mostly from investing and banks. That means we can have fear of missing out, market hysteria, hype and so on, which for a normal commodity is usually limited by let's say real or useful demand. I don't want to keep repeating the same things. I talked more about this in the first minutes of this video some months ago, so make sure to check it out. To begin with Newmont, this is the number one gold miner on the planet by production. They recently bought Newcrest and I want to briefly mention that this is how these companies develop. For that they generally issue stock, but you don't really get diluted since you get assets, cash flows, production capacity and so on. I know this is an argument in the market and I just want to clarify that this is very different from normal dilution. Yes, there are more shares overall, but depending on the acquisition you get the same or even more assets and cash flows and stuff for each, on top of potential synergies. The all-in sustaining cost is getting quite high and Newmont alone is definitely a reason why the median production cost is up. They are working on rebalancing the portfolio and they want to focus on the tier 1 mines instead, which are clearly superior from any point of view. So when Newmont manages to improve the portfolio, I think this can be a more appealing option for the market, even if it would be smaller overall. It's actually kind of a complicated position because you have to think, sell it now when gold is high and 97% of the production on the planet is profitable, or wait. If you wait too long and the price of gold falls, you risk being stuck with some unprofitable assets. And then when the market has issues, who buys a mine that produces gold at let's say 2000 per ounce when gold is 1800? In the current state, assuming normal CAPEX and about $1 billion added from Newcrest, they can probably make around 4.5, maybe over 5 billion per year. That's not bad at all for a 45-50 billion market cap and it's among the cheaper ones today. But again, if they sell assets, they won't be able to make that much, so that's something to keep an eye on. Financially, they are in a good position, with the current assets covering the current liabilities and a majority of the long-term debt. We can see here what they want to sell for now, by the way. It will depend on the deal, but maybe like 3 billion in cash. Anyway, close to 30 billion in equity is not really the best on this market cap, but as you are about to see, it's not the worst. With such a company, this is a very important number because they don't rely on digital assets and everything that matters is physical, so it's in the balance sheet. That means the assets, including the mines that produce at very high all-in sustaining costs that they are trying to get rid of, come at a premium, which doesn't make a lot of sense. They had a dividend policy based on the price of gold and cash flows, but after Newcrest and gold going up so much and the cash flow not following due to the higher CAPEX, they aren't really focusing on that. But at full potential, this could pay something around 10%, but it's very unlikely to see them do that. They aren't really that kind of company as far as I know, maybe possible to see them ramp up the buybacks instead. So overall, I guess it's a good one to begin with and have something to compare the others with. At this point, it's mostly about what they could look like after rebalancing the portfolio, because now it's not that appealing. They aren't terrible, I think they just overextended and they are working on that. Good financials, can make a lot of money, has some good assets, so we'll see. Now Barrick, this is currently the number 2 gold miner by production with very solid reserves that can last them for about 15 to 18 years. This company has some of the best tier 1 gold mines on the planet and also plans to basically double the copper exposure by 2029. They recently finished and commissioned the phase 2 of an expansion at one of their largest mines and the other projects are also progressing. What it means is lower production and higher all-in sustaining cost, which got to over 1,500. But now, when production is expected to normalize, that should help decrease the cost. They have other projects and together with copper, they expect to get to around 7 million gold equivalent ounces by 2030, meaning over a 30% increase. Copper, again, has very high potential from pretty much any trend we talk about today and I'd say it's one of the best commodities to have. Why I mention it is because Barrick has the potential to become one of the biggest copper miners on the planet in a time when the commodity is pretty much vital. This graph doesn't show all of them, by the way. Codelco, BHP and I think Glencore are missing. Despite this, they can probably make around 1.5 to 2 billion this year and potentially get to around 2.5, maybe 3 next year, depending on the CAPEX and the price of gold, of course. I mean, just normalizing the CAPEX, not even the production, would probably get them to that level. That, for a market cap of around 30 billion, is a ratio of around 10 next year up to 20 today. That's around average to even low in the current market. Financially, we see a healthy position with the current assets covering the current liabilities more than twice and even the company's debt. There is a lot of cash and what's actually pretty rare, as you'll see throughout the video, is that the equity is around or even below the market cap. So in this environment and with the potential from copper and so on, you can buy this below the net asset value. Others in this market are at a ratio of like 1.5 to maybe 2.5 today. So this is pretty cheap from any point of view if you compare them to the others, but that's not the point of the video. But the natural recovery in cash flow soon, followed by potentially higher dividends and buybacks, could give it a little boost. They see quite a ramp up or a recovery in Q4 in pretty much all the major projects, which, if true, can be a confidence boost for the market. By the way, we see the 2 billion in provisions on the balance sheet and a part of it is for the lawsuit they are disputing right now, I think, filed in 2022 by people in Tanzania. This is actually the third time it happens in about a decade, with the previous two being settled outside the court. I mention this because we have to keep this kind of risk in mind for any company with operations, especially in Africa. If you look into it, this happens in literally any industry and it's really sad to see. The dividend policy basically guarantees that the company focuses on developing itself and then, in good times when they have the balance sheet for it, they would pay quite good dividends. Especially if bought at 10, 12, this can be a pretty significant yield even if it's not the maximum. They can always pay special dividends or continue the buybacks if they really want to and feel like the company is in a good position to do it. Even if it's a relatively new policy, they've always been pretty cautious with the financial position and how much much they paid, which may be a reason why the stock never really took off. But, long term, a company that focuses on developing itself instead of wasting the money on buybacks at all-time highs should probably be better, and this can open potential opportunities. Now, something about Barrick is that the CEO hinted at a retirement in 2026. At the same time, they are looking for mergers and acquisitions. It's just a guess, but I think it would be possible to see them merge with a company like Agnico, making the number 1 player, Kinross to solidify the number 2 position, and so on. Barrick's current CEO is actually the CEO of the smaller company from the previous big merger they had. I think the timing and stuff may be pretty interesting. Again, just a guess, it can be someone from inside Barrick or another company as well. I mean, he'll be 67 by that time, so it's very likely that he will not go for another term, so something will probably change. So overall a good company that's still at a decent price. Once the CAPEX and production normalize, they can focus on improving the balance sheet and can rapidly get to a nice dividend and even buybacks. Good financials, good production and also a bonus from copper, decent all-in sustaining cost and overall my go-to in the industry. It's definitely not the best gold mining company as you are about to see, but balancing everything with the price, it's probably one of the best picks for me. Now Kinross, this one has 6 mines producing around 2.1 million ounces, with 2 of them providing more than half of the production. The all-in sustaining cost is around the median, expecting it to reach around 1.36 thousand this year. They had a record cash flow in Q3, overall delivering 905 million this year. That for a 10-12 billion market cap today is actually quite a good ratio and it could easily get higher. As they say, this has an attractive valuation and actually very strong cash flow for its size, making it an interesting acquisition target. I think this definitely has potential to be bought by one of the top 3 or even merge with AngloGold or Gold Fields or something of a similar size. They also talk about the impact of inflation on ultimately the cash flow. As we can see, higher cost of fuel, power, labor and so on ultimately means higher CAPEX and lower OPEX, which is a reason why companies aren't really performing the same as in 2020. Back then they benefited from a high price of gold, but the cost of producing it didn't really follow. Then you had the cost going up over and over while gold actually went down a bit, on top of them entering a repair and maintenance cycle, and now we have this jump in price again. So that combined with higher CAPEX and a lower production because they often develop or repair the current projects because they got an influx of money thanks to the boom means a generally worse performance and higher all-in sustaining costs. That eventually normalizes and many of them get out of this cycle as ultimately better companies. If gold now stabilizes at around 2.5 thousand, let's say, inflation falls, production gets back to normal, we can see some massive cash flows. Financially, we see a healthy balance sheet with the current assets covering the current liabilities. They also don't have a lot of debt or long-term liabilities and in fact they repaid quite a bit this year. This can allow them to focus on higher dividends in the near future and they can also access more debt if needed, so they are in a very healthy and flexible spot, especially since they are quite profitable. We see around 6.8 billion in equity, which is again okay for the current market cap. Comparing them to peers, I'd say this is around the average we can see in this market. They could also use the valuation to develop by buying other companies because this is not really a small company, it's among the biggest players on the planet. An issue with them is that again they depend a lot on 2 mines, the number one being in Africa and the other in Brazil. I like Brazil and I have some amazing very profitable investments there, but Africa can be very unpredictable. Although it's a bit more stable now, Mauritania, like many other African countries, has an unfortunate history of military coups, corruption, poor work ethics, accidents and so on. It's unlikely to see them hurt or fully nationalize the gold mines, for example, since that's a key source of money even for a corrupt government, but higher taxes or tariffs could be possible and we've seen that before. They can't really do much about it, so it's just a risk to keep in mind. So, an interesting one that has potential to be the target of an acquisition or a merger. Again, Barrick, Agnico, Newmont, or even a company of a similar size could be interested in the assets and especially the production. It was a potential buy a year ago when I looked into them, but now, after the price went up so much, it's more of a fair value in this environment, give or take. Again, this is normal behavior for a gold miner in such an environment where gold is breaking all-time records over and over. I think that once Barrick, Newmont, Agnico and so on are done with the current projects, so relatively soon, they might be even more interested in acquisitions. Kinross, overall, good financials, good production cost, okay assets, decent price, so definitely one to keep in mind. I think if we keep seeing the current environment, this one has a very good chance to be in the news quite soon. Now, Alamos, this is actually one of the best gold miners I've seen. As you are about to see, they have the all-in sustaining cost, financials, production, cash flows, growth potential and basically everything I want from this kind of company, except for a higher dividend because they are developing. The stock almost tripled from 2022, acting, I'd say, normal given the company's developments and the price of gold. They keep reporting record revenues, cash flows, profits and so on quarter after quarter. They recently made an acquisition and because of it, we can't really rely on the current cash flow. They basically bought a neighbor and thanks to that, they can actually generate significant synergies. You can see on the screen how they estimate about 515 million in total synergies and probably very important, this would make them the third largest Canadian gold producer. They were number 3 even before, around 3 or 4 actually, but combining the assets and the potential, they can even double the production in the near future. Together, they have the potential to produce even over 900,000 ounces in the long term, so basically a 3x on top of an already significant 25% increase in production this year. Why this is important is because now if the number 1 or 2 or anyone else wants to expand, which they do, they have another option. It's obviously easier and more efficient to buy a larger company if you want significant increases in production. And the acquisition shows a much better picture of what these assets can do together than if they were to buy Alamos and Argonaut separately. For Newmont, for example, the latter was probably insignificant and flying under the radar, but now it comes in a package together with Alamos. Now, the cash flow is 200 million in the past 9 months, so before the purchase, which was completed this summer, but in Q3 they made 87.5 million together, which is 350 annualized. Anyway, let's assume 300 million with gold at 2.5 thousand and we are at a very similar ratio to Agnico, which I think is very much justified. At the same time, we see a significant increase in growth capital expenditures as the company is developing a couple of new projects. They can also further develop the mine that they added recently, so there is a lot of potential inside what they already have, without having to look for another merger or acquisition. This is actually a top quality company with a very low all-in sustaining cost. It was higher in Q3 and will be higher in 2024 due to significant expansions, but even then, they expect it to be around 1.3 thousand, which is below the median. Even if it remains at 1.3 thousand in the long term, it may still be enough for them to be profitable almost no matter what, and it could also attract a potential buyer that wants to lower its average cost. Financially, we see a good position with the current assets above the current liabilities and a lot of assets covering the bit of debt that they have. There is about 3.5 billion in equity on a 7-8 billion market cap, so basically 2x the net assets. This is very similar to Agnico and it's, I'd say, normal for a higher quality company in this environment. If they want to, there is room to get some cheap debt, but I think issuing some stock to maybe buy another neighbor would be the optimal thing to do at this valuation. Again, wasting it when you are valued at so much above the average gold company would really be a shame. You are sitting on a literal gold mine, which may not be the case if the price of gold falls. This merger shows how something as simple as having the mines one next to another and sharing the infrastructure and processing capacity can save a lot of money for a small company. Add the good financials and very low production cost and you are looking at a very likely acquisition target for a company like Barrick, Newmont or especially Agnico. This would make a lot of sense for Agnico since it would be okay if they issue stock to buy them and it would solidify a very strong low cost position. If I manage to get them at low lower prices, I think this one is definitely a buy for me. It may be one of the best, if not the best, gold miner in this market. Even without an acquisition, this would be a great position in the portfolio by itself. I'd say this is around a fair price right now given the price of gold and the company's quality, but I'd prefer to buy it below that, of course. Not to mention that there is obviously potential to see them crash if the price of gold continues to fall. But still, for now it's definitely a very good one to keep an eye on. Now, B2, this company currently has 3 active mines in Africa and the Philippines and is able to produce around 1 million ounces at a very low cost, even lower than Alamos. They recently sold a smaller mine and plan to open another that should be ready in the second half of the year, and on top of that, they had some delays that resulted in a significant drop in production at the company's largest mine. That led to a much higher all-in sustaining cost compared to the normal 1.2 thousand, which they should theoretically get back to relatively soon unless they have other issues. They see a roughly 20% increase in production next year, which could be huge with gold at such a level, especially since that's not even the full potential of the new mine. In total, by the end of the decade, they see the potential to add about 600,000 ounces of production, meaning a more than 50% increase, making them one of the largest gold miners on the planet. They have very high CAPEX and a lower production now due to the project developments, but normally they should be able to make something like 4, 5, 600 million today, which is very good for a 3.7 billion market cap. That's a ratio of around 7, which is actually the lowest in the video. But with the new mines and everything, this company has the potential to make even 800 million to a billion, which would be extremely cheap at this price. Financially, we see a very good balance sheet with the current assets covering the current liabilities and the long-term debt. If you look into the other liabilities, we see a majority being in streaming obligations and prepaid gold sales, meaning things that they'll pay as they mine. Even with the recent adjustment in assets, there is about 3.2 billion in equity on a 3.7 billion market cap, so not terrible. By the way, good thing that they did the adjustment, because if you look at a company with a price to book ratio of let's say 2, they can always do some adjustment and push it to 3, so in reality you really overpay for the assets. This is why a lower one is usually better for a margin of safety. You know, if it's 0.8 and they adjust it to 1.2, it's not a big issue. The dividend is a pretty significant 5.6%, meaning about 210 million per year. That should be very sustainable, and when the CAPEX normalizes, they can easily even double it or do some buybacks on top. I think that's the biggest yield in the video, and that's a potential payout of like 30-40%, so there is potential. The main issue, and honestly maybe the only reason in my opinion why this isn't the same as Alamos, is the exposure to Mali. I think it was Barrick recently that had some delays or renegotiations or something about the government's ownership in the mine. It's not uncommon to see the government own even 50% plus 1 of a mine and only allow the company to operate it, but it's more about the stability of that government. They probably aren't going to take away the mine or something like that, but you have to think about the market because that's what decides the price. This is more about the impact on the stock, not on the company. Any kind of destabilization or political issues and stuff is enough to scare the market. By default, the country's credit rating, for example, has an impact on the stock because big money actually cares about that. This can be undervalued forever if the market doesn't do something, and at best you risk making something like a 20% profit if another company buys them. They could maybe do buybacks, but it doesn't guarantee anything. Even if the company is doing very well, there is the risk that the market doesn't want it. At the same time, the market can also gain a lot of interest, and we've seen this jump significantly in a relatively short amount of time. Anyway, what's guaranteed is that this one will be more volatile than the others, which isn't a bad thing. Overall, I like this one, and at this price I think the risk may be worth it for me. It's ultimately about the risk and reward, and I think that B2 may have potential to see some good upside in a relatively short amount of time. Very good financials, production cost and everything coming at a relatively low price. If everything goes okay, they can even make enough money to significantly develop outside Mali, which can be seen as a positive for the market in the long term. So I think they have short, medium and long term potential, and the balance sheet plus low production cost allow them to not be affected affect it that much if the price of gold falls and continue developing. It's on my watch list and I'm considering opening a position. You can see on the screen a summary of these companies and what I consider to be important indicators. Again, same as last video, my picks would be Barrick, maybe B2 and Alamos, but not at this price. There is a clear disparity in valuation between Barrick and Agnico, for example, as we can see, that may not be very justified. I get paying a premium for Alamos or Agnico's quality or less for B2's exposure to Mali, but at the same time, why pay so little for Barrick? I mean, it's not the highest quality miner out there, but even with normalized CAPEX, Barrick is valued like 30-50% cheaper than Agnico based on what they can make. And I'm not saying Agnico is the expensive one, that's what I would call normal in this environment. If you look at silver companies, some of which are like 60-80% gold miners, that's where you see some extremely high valuations for no reason. Overall, a bunch of good companies, and we see a clear trend that's actually pretty unique for a commodity that's at its highs, where they don't really invest in increasing production. This will have an effect on the future supply and demand balance, and if there is a recession or something, gold prices could easily jump. Even without a recession, rate cuts might also be enough to at least help it stay around 2,500-3,000, which would be amazing for gold companies. At such prices, they can literally make a fortune, and this for 1-2 years can be enough to secure the higher CAPEX projects they have right now and then focus on significant dividends and buybacks. We already see many significant cash flow improvements lately, and that's in a time when many of them got into big upgrade or repair projects, meaning higher CAPEX. And the general increase in operating cash flows now can be a sign of what's to come if gold remains at such prices when CAPEX eventually normalize. When Barrick or Agnico, for example, make like 3 billion per year, you suddenly can see massive dividends and buybacks. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.